Well, joining us right here in the studio is Choyleva. She's director at Lombard Street Research. We've got that piece of paper to you with the exact numbers on them.
Yes, we have the numbers here.
Okay, so, I mean, how does it compare to what you were thinking?
Well, actually, this is really bad news. 17% year-on-year export growth, 17.1, actually means, I mean, it's almost meaningless to look at year-on-year growth rates if you're trying to figure out what's going on right now. And if you seasonally adjust Chinese export data and you try and look at sequential growth, this 17% year-on-year growth rate suggests that exports actually fell in the third quarter on the second quarter.
So that tells us about the world economy, doesn't it, more than anything else?
It tells us that the only thing that has kept China's economy going through the summer was, or in the second quarter, was strong export growth, because actually exports rose by 6.4% in Q2 on Q1. In fact, imports fell by 1% in Q2 on Q1, which suggests that domestic demand growth tanked.
Which is what they're relying on, really, aren't they?
Well, which would be what would be best for the global economy to grow strongly. In fact, China has had to hammer its domestic demand growth because the economy is overheating. The only thing that kept overall growth around trend was strong export growth. Now, clearly, export growth has come off. 0% or falling exports, I think, is probably minus 0.5. I obviously have to go back to the office and calculate the numbers, but the 17% suggests to me that this would be a quarterly fall in Q3, which is really bad news. But also, if you look at the import growth data, that also suggests that imports at best stayed flat. They might have even registered a small fall, which comes on the back of that 5% fall in Q2. So that suggests to you that domestic demand continues to struggle significantly.
But it could, in a way, have a silver lining to, if we do have lower growth in China, which is what this data perhaps suggests, that could help with the inflation picture, couldn't it?
Absolutely. Well, they had to do that because they stimulated their economy massively with an absolutely gigantic monetary stimulus, and they overheated within a short space of time. So they needed to rein in, and they needed growth, GDP growth, well below trend in order to curb the inflationary problem that they created. The problem, of course, for the global economy is that we are in a world of deficient global demand. So it's not necessarily good news from the point of view of growth, and from the point of view that actually for the rest of the world, or for the global economy to rebalance in general, we need strong Chinese domestic demand.
Jana, I just one of your quotes here at the moment, it is that Chinese authorities have been left in a rather sticky situation, and one largely of their own making. Explain.
Well, what I mean is that, one, they went for this massive monetary stimulus, but second, they were too late in withdrawing it. So they created this massive inflation problem, but they also, when they were withdrawing it, they used the wrong measures. If they had allowed the exchange rate to appreciate much faster, or if they had used more their domestic interest rate to adjust, they would have achieved a better result than using administrative control, whether it's price control or credit quotas.
Tier ratios, etc. But with all that in mind, let's just have a look at the state of play when it goes. I mean, is China headed, A, for a hard landing here, and B, what about the inflation picture, because it has been stubbornly high, but once that comes under control, the PBOC has many bullets left.
Well, if we define the hard landing along the lines, let's say that real GDP growth quarter on quarter in annualized terms averages below 5% from Q3 this year into Q2 next year, then I definitely say that China is in for a hard landing, and these trade data out today confirm that certainly the Q3 growth number might not show up in their official estimates, but quite likely the situation there already is, or the hard landing already is in motion. Now, you're absolutely right that they still have ammunition to try and stimulate next year their economy once inflation, because inflation is going to stay stubbornly high this year, but if we are right about...
Everybody thought we were going to peak in August, but it doesn't seem that way, does it?
We have been getting the inflation story on our side right, so we are not surprised particularly. But the expectation is that if the hard landing does come through, then next year inflation will start to slow down. And of course, even if it slows down a little bit, that gives the opportunity for the Chinese authorities to start worrying about growth and start doing something about it. And they have ammunition. The problem is that it's a lot less ammunition than last time around.
Okay, we saw the state-controlled company take greater shares in banks, in 4 big Chinese banks earlier this week. That sent them up. But there's a report from Credit Suisse saying that the bad loan issue is something which is rearing its ugly head, and that things may get worse there as well. What do you make of that? And is that one of the biggest dangers to the Chinese economy looking ahead?
It is. Actually, China's banks are in a precarious situation. The story, though, has been that Chinese banks can be totally insolvent, but it doesn't matter as long as they're liquid. And here the inflation story plays a key role, because actually it's inflation that undermines or can undermine bank liquidity, whether it is by incentivizing people to try and get their money out of China through the porous capital controls, or just get them out of the banks, because household deposits are 2/3 of their financial assets, of household financial assets, and they're earning negative real returns in bank deposits. So there is a greater incentive for, when inflation is accelerating like this and when the authorities are not moving the deposit rate, for households to start withdrawing their money into the banks and putting them more in the grey economy. And once you disrupt that balance, then you can expose the huge problems in the Chinese banking sector, because for sure they have massive amounts of bad loans, and the official NPL ratio probably understates that to a large extent.